Profit booking is crucial in this dynamic and uncertain world. It helps to protect our capital and sleep better at night. I have created this video based on the request of a subscriber. Welcome to Ultra Profits. I'm here to help you grow serious wealth by showing you how to invest smarter and go beyond average returns. I will discuss 4 strategies to book profits systematically. These strategies are based on sound investment practices and not trading style thumb rules. So they will be suited for ETF or mutual fund investors and not for stock traders. Watch till the end because I'm going to tell you how you can use the strategies depending on your investing style. First strategy is a rebalancing portfolio. You have to decide between two parameters. What will be your asset allocation mix? For example, it can be 80% equity, 20% in debt. Decide it based on your risk profile. Second is a rebalancing frequency, whether you want to rebalance every quarter or every month. Now, let's see an example. Your predetermined asset allocation of 80-20 has become 85-15 due to a bull run. You need to rebalance it by selling 5% of the equity and move it to debt. This creates automatic profit booking and also automatic investing at the market bottoms. It protects your portfolio during market crashes. For example, in COVID crash, when Nifty fell 30%, your portfolio would have fallen 24% for an 80-20 asset allocation. When you add additional funds, add it to the component equity or debt, which needs to be increased. This will minimize sell transactions and hence the tax. Second strategy is on goal-based withdrawals. If your goal, say retirement or child's education, is 2 to 3 years away, it's time to reduce exposure to volatile assets. Gradually move from equity to safer options like liquid or short-term debt funds. This also ensures that you book profits on the gains that you made during the initial years. Also, you don't miss out on any potential bull runs in the later years. But you are absolutely ensured of a good amount in the year of that goal. In this example, if the goal is in the 5th year, then gradually reduce the equity component from year 3 and keep moving it to safer instruments. This way, goals are not impacted due to market fluctuations. Reducing equity locks in gains and avoids panic selling if the markets fall. The third strategy is rule-based rebalancing. Let's say your mutual fund or ETF gives you 25 to 30% annual returns for 3 years, far above expectations. That's a red flag that the asset might be overvalued. Booking partial profits helps lock in gains and de-risk your portfolio. Now, how do we find whether the asset is overvalued? There are two simple indicators. One is Nifty P ratio, the second is annualized returns. Let us take an example of Nifty P ratio. The blue line is the average P and the red line is the Nifty P that year. In year 2, when the Nifty P is above the average line, then you can book some profits since it means that the valuations are high. Similarly, in year 3, when the P drops below the average, then you can invest more, and so on. Now, the fourth strategy is the smarter, hands-free option many investors miss, the hybrid funds. Within hybrid funds, there are multiple categories, each with varying asset allocation ratios and how they approach the rebalancing. These funds automatically balance equity and debt, meaning they book profits from equity when the markets rise and shift to debt, and vice versa when the markets fall. So in a way, hybrid funds do what disciplined investors should do, but automatically. The rebalancing is done based on the processes of the fund house. They could use various valuation parameters to shift between equity and debt. And here is the best part. When this rebalancing happens within the fund, you don't pay capital gains tax every time they adjust the portfolios. Now, all these strategies keep the human biases out of investing and follow a disciplined process. In terms of using these strategies, rule-based exits are the most complex. Let us also look at the tax angle. Any profit booking will involve capital gains taxes. Except for hybrid funds, you don't have to pay taxes for the rebalancing done by the fund manager. Now on the applicability, rebalancing portfolio strategy is suitable for DIY investors. It is fairly simple. Goal-based strategy can be used by anyone and is great for the various life goals with varying timelines. Hybrid funds are the best for someone who prefers to be hands-off. You can almost invest and forget it for a long time. Now, these are the various profit booking strategies. Now, my views before we close this video. First is automate the investment process as much as possible. Create rules which will help you stay disciplined. Second, if you can afford to take risk and stay invested for a long term, then go for mid and small cap funds. They are still the best bets for creating outsized wealth. Third, if your risk appetite is low or moderate, if you are nearing retirement, etc., then consider hybrid funds or go for a conservative asset allocation like 60-40 or even 50-50. If you need a detailed video on any of these strategies, leave a comment and I'll create one. If you like this video, then hit like and subscribe to my channel for more such informative videos. Thank you.